Most people don't know that. This is a very good inflation indicator announced between BlackRock and Coinbase to partner so that BlackRock could, through its Aladdin technology solutions ecosystem, on which $40 trillion worth of assets sit, they wanted a seamless on-ramp into crypto that Coinbase is going to provide. So this is another legitimization of Bitcoin and crypto generally as a new asset class. Some of this may have been caused by demand pull, institutions saying, hey, we want to get involved, and they're trying, but the plumbing was just too difficult. So that's good. 200-week moving average of Bitcoin. Remember, Bitcoin peaked close to 70,000 last November, and it got down to somewhere in the $17,000 range very recently. And that broke the 200-week moving average. So that was a very negative sign. So the technicians out there were saying, well, if it cannot reclaim and get back up there pretty quickly, then we're probably going to 10 to 13,000. It has reclaimed the 200-week moving average, which is a little bit above, I think, 21 or 22,000. So that's reassuring. We've seen some stabilization there. And the decline this time around, believe it or not, it was pretty intense, but was not as steep as it has been in the past. Normally it's more than 80% decline. So this was close, but we didn't quite get there. And if we're right, that 40 trillion just from BlackRock's platform, hosting other institutions, that would translate, if you just took our study, which basically said if you want to access crypto, but you want to minimize, you're more focused on minimizing volatility than increasing your Sharpe ratio, then you would put 2.5% into crypto. And if you're more interested in the Sharpe ratio, so returns per measure of risk, than you are about volatility, you'd put 6.5%. So assuming that 2.5% on this $40 trillion platform, that's $1 trillion of demand. Now, it's not that, and that would more than double the Bitcoin price right there if we just assumed it was all done in Bitcoin, which this agreement is only focused on Bitcoin. Now, what that misses, however, is what we call illiquid supply. There are hodlers out there, holders for dear life, or forgotten what that's all about, hold on for dear life. And so the illiquid supply, according to our estimates, is about 14 million out of the roughly, I think we're into near 19 million, 18 to 19 million Bitcoin outstanding. So illiquid, 14 million. And by our calculations, only 3 million units are truly liquid. The demand, if we were to see a $1 trillion increase in demand, it would probably drive the price up much higher than the doubling that I just mentioned. On to market indicators right now. Well, July was a great month for innovation generally. I would say since mid-May has been a very good month, but in July specifically, the two best performing sectors, consumer discretionary up 15%, technology up about 13.5%. Many of the stocks that cause that are associated with true innovation, disruptive innovation. On the lower end of the return scale, you had comm services up 1%. So that's Facebook and a lot of the social media platforms, which are being pummeled by cuts in advertising. And that's another confirmation that we're in a recession. Advertising is highly discretionary, and companies can pull the plug on it quickly, and they have. Communication services, and then healthcare is the other one that had only a 1.5%. I think the fears associated with the fiscal plan that just passed were part of the reason for that. In the fixed income markets, of course, the Fed increased, and everyone anticipated that the Fed would increase interest rates by 75 basis points on July 27th. That happened. But interestingly, the long-term interest rates did not cooperate, or have not been cooperating with this idea that they should be going up in lockstep with what the Fed is doing. Instead, what we're seeing is long-term interest rates peaked on June 14th at 3.5%. So this is the 10-year Treasury bond yield. June 14th at 3.5%, and even after a bit of a backup today in response to the employment report, the interest rates are down almost 70 basis points to 2.83%. Meanwhile, short-term interest rates, 2-year Treasury yields, they have moved up in lockstep. They're at 3.24. So now we have an inverted yield curve to the tune of 41 basis points. It's just getting more and more inverted. And that's basically the fixed income markets telling the Fed, something's going to give here. It's going to be the economy, which is caving in many ways, or inflation, or both. Now, in terms of commodities, the commodity market, lots of evidence there. Just take copper. Now that's a metric that's really a gauge of how strong the economy is. And so that was fluctuating in the $4 to $5 per pound range for about a year. And the copper price peaked finally at roughly $5 in March. And they're now down to $3.54. So that's down 25%. And if you're looking at month to month and year over year, they're both down about 25%. That is going to get into the inflation indicators. And we think the answer is both. And we also think, and I'll get into this in a moment, that the surprises are going to be quite significant on the downside when it comes to inflation. On the high yield spreads and credit default swaps, both of those have been settling down as well. So those were moving up fairly rapidly, as I had featured in prior months, but they're settling down. The credit default swap average peaked on June 30th at 104 and is now down to 81. Let's see, the high yield spreads, and what that means is the spread over Treasury yields that these high yield bonds are. They were 6% higher than the 10-year Treasury yield on July 5th, and now they're 4.9%. So that's saying with the rally in July, and the rally happened, I believe, because there are more people believing we're in a recession and that inflation will come down. So that rally has taken some of the worry out of these other markets.